There is a single word that lives in the glossy pages of annual reports and echoes through the conference calls of the world's most powerful executives. It's a word that sounds like progress, like innovation, like intelligent design. It promises a future where 1 + 1 = 3. It's a word that has launched multi-billion-dollar deals, graced the covers of business magazines, and sent stock prices soaring on the day of its announcement. But this word is also a ghost story told in the language of corporate finance. It is the siren song that has lured countless companies onto the rocks of financial ruin, and in the process, has vaporized the retirement savings of millions of retail investors who believed the beautiful lie. Warren Buffett, the master of value investing, knows this word better than anyone. He views it not as a promise, but as a warning. He hears it, and his hand instinctively moves to protect his wallet. That word is synergy. And understanding its true meaning, the dark space between its promise and its reality, is one of overpaying for the simple, intoxicating thrill of the chase. This isn't just a lesson in corporate finance, it's a deep dive into human psychology, executive ego, and the powerful forces that compel smart people to make disastrous decisions. By the end of our journey today, you will possess a powerful filter, a mental model that will allow you to read a press release or an annual report and see not just the words on the page, but the hidden truth behind them. You will learn to spot the red flags that 99% of investors miss, protecting your portfolio from the single greatest threat to long-term returns: bad management. This is the skill that separates the amateur from the professional, the spectator from the owner. This is how you stop gambling on hype and start investing in value. Let's begin by traveling back in time to the absolute peak of dot-com mania to witness the birth of the deal that would become the poster child for synergy-fueled destruction. The story of the merger between America Online and Time Warner is more than just a case study. It is a Shakespearean tragedy of hubris, delusion, and financial devastation. The year is 2000. The internet is a tidal wave, a force of nature reshaping the world, and at its crest rides AOL, the company that brought America online with its ubiquitous dial-up tone and its flood of free trial CDs. AOL, led by its charismatic chairman Steve Case, was the king of the new media. Its stock price was a rocket ship, detached from old-world metrics like profits or cash flow. It was valued on eyeballs, on clicks, on the promise of a digital future it seemed destined to own. On the other side of the table was Time Warner, the titan of, quote, old media. The empire of Jerry Levin, Time Warner was a behemoth, a colossal collection of irreplaceable assets. It owned Warner Brothers Studios, the creators of cinematic history. It owned HBO, the undisputed king of premium cable. It owned Time Magazine, CNN, and a vast network of cable systems that were the physical pipes into American homes. It was a fortress of content and distribution. On January 10, 2000, these two worlds collided. AOL announced it was acquiring Time Warner for an astonishing $164 billion, the largest merger in corporate history. The announcement sent shockwaves through the global financial system. On the surface, the logic was intoxicatingly simple, a perfect story for the new millennium. Steve Case and Jerry Levin stood side by side on television, beaming, selling the world on a vision of unparalleled synergy. The narrative they spun was a masterpiece of corporate storytelling. AOL had the massive online audience, the digital savvy, the new media distribution. Time Warner had the world-class content, the movies, the shows, the news, the music. Together, they would be an unstoppable, vertically integrated behemoth. Time Warner's movies and music would stream through AOL's service. Advertisers would flock to a platform that could offer integrated campaigns across television, print, and the internet. AOL would get access to Time Warner's high-speed cable lines to move its customers from slow dial-up to the promised land of broadband. It was the ultimate marriage of content and distribution, the perfect synergy. The market, caught in the fever dream of the tech bubble, bought it hook, line, and sinker. Analysts released glowing reports, predicting endless growth. The financial press hailed it as a visionary masterpiece, a deal that defined the future. The word synergy was everywhere. It was in every press release, every interview, every justification for the astronomical price tag. The promise was that these two companies, once combined, would generate profits far beyond what they could ever achieve alone. This promised value, this synergy, was the sole justification for the massive premium AOL was paying. But beneath the surface of this beautiful story, the foundation was rotten. AOL, the acquirer, had a market capitalization built not on tangible earnings but on the ephemeral hopes of the dot-com bubble. Time Warner, the established giant, was effectively allowing itself to be purchased with what would soon be revealed as monopoly money. The retail investor watching this unfold was faced with a choice. The 99% saw the headlines, they heard the CEOs, they saw the stock prices jump, and they felt the powerful pull of FOMO, the fear of missing out on the next great thing. They saw a story that made perfect sense on the surface, and they piled in, buying shares of AOL and Time Warner, believing they were getting in on the ground floor of a new media empire. They trusted the executives, they believed the narrative, they fell in love with the synergy. But a value investor, one trained in the skeptical school of Warren Buffett, would have started asking different questions. They would have applied the mental model of inversion. Instead of asking how will this create value, they would have asked, what are all the ways this combination could go horribly, catastrophically wrong? And the potential for failure was immense. The first and most obvious friction point was corporate culture. AOL was a fast-moving, aggressive, sales-driven tech company from Dulles, Virginia. Its employees wore jeans to work. Time Warner was a buttoned-down, bureaucratic, New York-based media conglomerate, with deeply entrenched fiefdoms and legendary political infighting between its divisions. How could these two alien cultures possibly merge and collaborate effectively? The second point of failure was technology. The promise of delivering Time Warner's content over AOL's network ignored the reality that the broadband future was not going to be owned by AOL. The cable companies, including Time Warner's own cable division, were building the infrastructure that would make AOL's dial-up service obsolete. The very asset AOL was trying to acquire held the seeds of its own destruction. The third point of failure, and the most critical, was the price. The valuation was based on the peak insanity of a stock market bubble. Any investor with a sense of history knew that bubbles always pop. When it did, AOL's inflated stock, the currency used for the acquisition, would collapse, revealing the true, ruinous cost of the deal. The collapse, when it came, was faster and more brutal than anyone could have imagined. Just a few months after the deal closed, the dot-com bubble burst. The tide of irrational exuberance went out, and it turned out that AOL, like so many other tech darlings, had been swimming naked. Its advertising revenue, a key pillar of the synergy argument, evaporated. Its dial-up subscriber base began to decline as users flocked to faster broadband connections offered by the cable and phone companies. The promised synergies never materialized. Instead of a harmonious collaboration, the combined company, now called AOL Time Warner, was paralyzed by culture clashes and internal power struggles. The old media executives at Time Warner resented the new media upstarts from AOL, and vice versa. The dream of a seamlessly integrated media powerhouse became a nightmare of bureaucratic infighting. The financial connection, the tangible result of this failed synergy, was written in blood-red ink on the company's financial statements. In 2002, AOL Time Warner was forced to acknowledge the grim reality. The company took a goodwill impairment charge of $54 billion. Let's pause and understand what that means. Goodwill, on a balance sheet, is essentially the premium a company pays for another company above the fair market value of its tangible assets. It is the accounting embodiment of hope, the capitalized value of future synergies. That $54 billion write-down was a formal admission from management that the synergies were a fantasy, and that they had overpaid to a staggering degree. To put that number in perspective, $54 billion was more than the annual GDP of most countries on Earth. It was an amount of shareholder value so vast, it's difficult to comprehend. The company would later take billions more in write-downs. The stock price collapsed, falling over 90% from its peak. An investment of $10,000 in AOL at the height of the hype would have been worth less than $1,000 just a few years later. The retirement dreams of countless employees and retail investors who had loaded up on the stock were annihilated. Steve Case was forced out. Jerry Levin retired in disgrace. The name was eventually changed back to Time Warner, a symbolic attempt to erase the memory of the most disastrous merger in corporate history. The story of AOL Time Warner is the foundational anecdote because it perfectly illustrates the seductive lie of synergy. It shows how a compelling narrative, amplified by a frothy market and executive hubris, can lead to the destruction of immense value. The 99% of investors who believed the story were financially ruined. The tiny minority who understood the psychological pull of the synergy narrative, who inverted the problem and focused on the risks, and who analyzed the astronomical price being paid, would have stayed far, far away. They would have protected their capital not by predicting the future, but by recognizing a timeless pattern of human folly. The word synergy didn't represent a brilliant business combination. It was the marketing slogan for the largest destruction of shareholder wealth the world had ever seen. And this pattern, of a beautiful story hiding a terrible price, repeats itself over and over again in the annals of corporate history, a constant trap for the unwary investor. To truly understand why these value-destroying deals happen with such depressing regularity, we have to look past the spreadsheets and the financial models and into the mind of the modern CEO. Why would a highly intelligent, highly compensated executive, surrounded by teams of brilliant advisors from the best investment banks, repeatedly engage in behavior that has been statistically proven to fail? The answer lies in a powerful set of psychological and institutional forces that warp executive decision-making, often compelling them to act against the best interests of the very shareholders they are paid to serve. Warren Buffett has a name for this phenomenon. He calls it the institutional imperative, and it is one of the most important concepts a retail investor can ever learn. The institutional imperative is the principle that organizations, like living organisms, have a mind of their own. It describes the tendency of managers to mindlessly imitate the behavior of their peers, no matter how foolish or irrational that behavior may be. If the CEO of a rival company makes a big acquisition, an invisible pressure descends upon every other CEO in that industry to do the same. To sit still, to patiently allocate capital, to do nothing, is often perceived as a sign of weakness or a lack of vision. Action, any action, is seen as leadership. This dynamic is a perfect storm of cognitive biases. The first is social proof. Human beings are herd animals. We feel safer and more confident in our decisions when we see others making the same choices. For a CEO, watching competitors merge and expand creates a powerful anxiety, a fear of being left behind. The board of directors starts asking questions. Analysts start downgrading the stock for its lack of a growth strategy. The pressure to do a deal becomes immense, not because a specific deal makes economic sense, but because deal-making itself has become the accepted norm. Layered on top of this is the agency problem, a fundamental conflict of interest in corporate finance. The managers of a company, the CEO, and their executive team are the agents. The shareholders, the owners of the company, are the principals. In a perfect world, the agents would always act in the absolute best interest of the principals. But we don't live in a perfect world. The incentives of a CEO are often profoundly misaligned with the incentives of a long-term shareholder. A CEO's compensation, prestige, and power are often tied directly to the size of the empire they command. A bigger company means a bigger salary, a larger bonus, a more prominent photo in Forbes, and a more important seat at the Davos World Economic Forum. An acquisition, even a terrible value-destroying one, is the fastest way to grow the size of the company. A deal that doubles a company's revenue overnight through acquisition might earn the CEO a massive bonus and industry accolades, even if it dilutes existing shareholders, piles on dangerous levels of debt, and lowers the company's long-term return on capital. The CEO gets the immediate upside of prestige and pay, while the shareholder is left holding a less valuable, more fragile business. Warren Buffett learned this lesson not just by observing others, but through his own painful experience. His foundational anecdote for the institutional imperative is the story of Berkshire Hathaway's own origins in the textile industry. When Buffett took control of Berkshire Hathaway in the 1960s, it was a struggling New England textile manufacturer. He quickly realized it was a truly terrible business. Foreign competition was brutal, the capital requirements were enormous, and the prospects for any kind of decent profit were bleak. The rational, economic decision would have been to shut it down immediately and redeploy the capital into better businesses. But he didn't. For years, he continued to pour money into the textile operations, buying new equipment and fighting a battle he knew he couldn't win. Why? He later admitted it was the institutional imperative at work. The business was there, the managers were there. The entire institution was geared towards one thing: making textiles. The momentum was too strong. The idea of shutting down the original business, the one that gave the company its very name, was emotionally and institutionally difficult. He was behaving like the very CEOs he would later criticize, pouring good money after bad out of a sense of obligation and institutional momentum. It was only after years of bleeding cash that he finally made the tough decision to close the mills and pivot Berkshire into the diversified investment vehicle it is today. That experience branded into his mind the danger of institutional momentum and the absolute necessity of rational, owner-oriented capital allocation. This is where the retail investor needs a powerful mental model to cut through the noise. The model is called the owner's test. When a company you own announces a major acquisition, you must stop thinking like a stock picker and start thinking like you are the sole owner of the entire business. Imagine you own 100% of the company, paid for with your family's entire net worth. Now look at the deal the CEO has just proposed. Would you, as the sole owner, make this exact same decision with your own money? This simple shift in perspective is transformative. It forces you to ask a different set of questions. Is this deal truly the best possible use of the company's capital? Or could that money be better used to pay down debt, buy back shares at a cheap price, or pay a special dividend directly to me, the owner? Does this acquisition genuinely increase the per-share intrinsic value of my business? Or does it just make the company bigger for the sake of being bigger? Is the CEO funding this with mountains of new debt that puts my entire business at risk if there's a recession? Crucially, you must also investigate the CEO's personal incentives. Go to the company's investor relations website and pull up the latest proxy statement, the DEF 14A filing. In that document, you will find a section on executive compensation. Read it carefully. Is the CEO's bonus tied to metrics like revenue growth or EBITDA growth? If so, that is a massive red flag. Those metrics are easily manipulated by acquisitions. A CEO can make himself rich by doing a deal that makes you, the owner, poorer. You are looking for a CEO whose compensation is tied to metrics that are much harder to game, like growth in per-share earnings, return on invested capital, or total shareholder return over a multi-year period. A CEO who is paid like an owner is far more likely to act like an owner. The antithesis to this diligent owner-like approach is the path of the 99% of investors. This is the path of blind faith. The average person sees a CEO on television, projecting confidence and authority, and they mistake that performance for competence. They assume that because this person is paid millions of dollars and has a fancy title, they must have a brilliant plan. They don't dig into the proxy statements. They don't question the incentives. They don't apply the owner's test. They simply trust that the professionals know what they're doing. This is a catastrophic error in judgment. The history of corporate America is a graveyard of companies run by confident, charismatic CEOs who drove their businesses into the ground through reckless, ego-driven acquisitions. Trust is not an investment strategy. Skepticism, diligence, and an owner's mindset are the tools of portfolio protection. The direct financial connection of the institutional imperative is brutal and clear. When a CEO makes an acquisition based on ego or flawed incentives, the damage flows directly to the financial statements and, ultimately, to your brokerage account. Let's say a company earns $1 million and has 1 million shares outstanding. That's $1 of earnings per share. The CEO, wanting to grow the empire, decides to buy another company. To do so, they issue 1 million new shares and give them to the owners of the target company. The new combined company now earns $2 million. The CEO gets a huge bonus because earnings have doubled. But what happened to you? The company now has 2 million shares outstanding. 2 million in earnings divided by 2 million shares is still just $1 of earnings per share. You, the owner, are no better off. In fact, you are likely worse off because the company is now larger, more complex, and harder to manage, increasing the risk of future problems. This is called dilution, and it is a subtle but lethal destroyer of shareholder value. Or, even worse, the CEO funds the deal with debt. The company's earnings might go up, but now it has massive interest payments to make. This increases financial leverage and risk. If a recession hits and earnings fall, the company might not be able to make its interest payments, threatening the entire enterprise with bankruptcy. The CEO got their bonus for doing the deal, but you, the owner, are left with all the long-term risk. This is why understanding the forces of the institutional imperative isn't just an academic exercise. It is a critical risk management tool for any serious investor engaged in stock picking and building long-term wealth. If the seductive lie of synergy and the institutional imperative are the disease, then what is the cure? For Warren Buffett, the antidote is a powerful two-part discipline that has been the bedrock of his success for over half a century. An unwavering commitment to his circle of competence, combined with a fanatical devotion to price discipline. This framework is not about complex algorithms or secret formulas. It is a philosophy of intellectual humility and commercial patience, and it is the single most effective defense against the siren song of the bad acquisition. It is the core of true value investing. The perfect foundational anecdote to illustrate this principle is not a story of a massive, headline-grabbing deal, but a relatively small, simple acquisition that reveals the core of the Buffett-Munger method, the purchase of See's Candies in 1972. At the time, Berkshire Hathaway was still primarily an investment vehicle, and Buffett and his partner Charlie Munger were looking for high-quality businesses to buy outright. They were introduced to See's Candies, a beloved family-owned chocolate company based in California. See's was the epitome of a business within their circle of competence. It was simple. It sold chocolates and candy from physical stores. There were no complex technologies to understand, no disruptive threats on the horizon. They could understand its economics completely. More importantly, they recognized that See's possessed a powerful, though unstated, competitive advantage. It had a phenomenal brand. For decades, customers in California had associated See's with quality, nostalgia, and special occasions. This brand loyalty gave the company tremendous pricing power. They could raise prices year after year to offset inflation, and customers would happily pay. Because buying a box of See's was an affordable luxury and a cherished tradition. This was a business they understood inside and out. It fit squarely within their circle, but understanding the business was only half the battle. The other half was price. The See family was asking for $30 million for the business. Buffett and Munger studied the financials. They saw that the company had about $8 million in tangible assets. Things like factories and inventory. The remaining $22 million of the asking price was for the intangible asset, the brand, the goodwill. This was a big step for Buffett, who up to that point had been a strict cigar butt investor, buying statistically cheap, mediocre businesses. See's was his first major purchase of a wonderful business at a fair price. They calculated what they thought the business was worth and made an offer of $25 million. The sellers were firm at $30 million. Buffett and Munger, despite loving the business, were on the verge of walking away over that $5 million difference. This is the crucial point of the story. There was no synergy to justify overpaying. There was no institutional pressure. There was only one question: does the price we are paying allow for an adequate return on our investment? Fortunately for them, the seller eventually agreed to their $25 million price. The rest is history. See's Candies went on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway, a return of over 8,000% on their initial investment. The key to that success wasn't just buying a great business. It was buying a great business they understood, and refusing to overpay for it by even a single dollar more than they thought it was worth. This story reveals the psychological principles that underpin Buffett's approach. The first is a powerful antidote to the Dunning-Kruger effect. The Dunning-Kruger effect is a cognitive bias where people with low ability at a task overestimate their ability. In the corporate world, this manifests as a CEO who has had success in one industry suddenly believing they are a genius who can conquer any other industry. This leads to a car company buying a software firm or an industrial manufacturer buying a movie studio. They venture far outside their expertise, blinded by overconfidence, and the results are almost always disastrous: diversification. Buffett avoids this entirely by rigorously defining and staying within his circle of competence. His famous saying is key: you don't have to be an expert on every company, or even many. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital. This is a statement of profound intellectual humility. The second psychological principle is the mastery of inaction. In most corporate and investment environments, there is a strong bias for action. Executives and fund managers feel pressure to always be doing something, making deals, buying and selling stocks. To sit patiently on a growing pile of cash is often seen as lazy or uninspired. Buffett is the ultimate master of inaction. He is perfectly happy to do nothing for years if he doesn't see a deal that meets his strict criteria of competence and price. He compares investing to being a baseball batter waiting for the perfect pitch. In investing, there are no called strikes. You can stand at the plate and watch thousands of pitches. Bad companies, overpriced stocks, hyped-up IPOs go by, and it costs you nothing. You only swing when a fat, slow pitch comes right down the middle of the plate, a business you understand at a price that is a bargain. This ability to resist the psychological and institutional pressure to act is perhaps his greatest superpower. So how can the retail investor apply this? The mental model is to consciously define your own personal circle of competence. This isn't about being a genius. It's about being honest with yourself. Get a piece of paper and write down the industries or types of businesses you genuinely understand. Maybe you've worked in healthcare for 20 years. That's in your circle. Maybe you're a passionate gamer and you understand the economics of video game companies. That's in your circle. Maybe you're a devoted customer of a particular retail brand and you understand its competitive position better than any Wall Street analyst. That's in your circle. The blueprint is a series of simple questions to ask yourself before buying any stock. Can I explain how this company makes money, who its customers are, and who its main competitors are, to a reasonably intelligent person in 2 minutes? Do I have a clear idea of what the major long-term risks to this business are? If this company were to announce a major acquisition, would I have the background knowledge to independently evaluate if it makes sense? If the answer to any of these questions is no, then that company is outside your circle of competence, and you should move on. It doesn't matter how exciting the story is. The goal is not to have a large circle, but to know precisely where the perimeter is, and to never step outside of it. The antithesis, the path of the 99%, is to chase what's popular. They hear about a hot tech stock on the news and buy it without any real understanding of its technology or business model. They see a biotech company with a promising drug and they invest, without the scientific background to evaluate the clinical trial data. They treat the stock market like a casino, betting on stories and trends they don't comprehend. This is not investing. It is speculation. And while speculation can sometimes lead to short-term gains, it almost always leads to long-term losses, because you have no edge, no foundation of knowledge to stand on when the story changes or the market turns against you. The direct financial connection of this discipline is measured by a crucial metric, return on invested capital, or ROIC. ROIC tells you how much profit a company generates for every dollar of capital it invests in its operations. A company that consistently generates a high ROIC, say above 15%, is likely a wonderful business with a strong competitive advantage. When a company makes an acquisition, it is a major capital allocation decision. A disciplined acquisition, like Buffett's purchase of See's Candies, adds a stream of high ROIC earnings to the company, enhancing overall shareholder value. A reckless, synergy-driven acquisition, where the acquirer overpays for a company outside its circle of competence, almost always results in a low or even negative ROIC on that investment. The acquirer might have spent $10 billion, but the new business only generates a few $100 million in profit, a pathetic return. This drags down the entire company's ROIC, signaling to the market that management is inept at capital allocation. As an investor, you can look at a company's historical ROIC over the past 5 or 10 years. Is it high and stable? That's a sign of a disciplined management team that understands its circle of competence. Is it low, volatile, or declining? That is a massive red flag, often the result of a string of bad acquisitions, and a clear signal to stay away. This single metric can reveal more about the quality of a business and its management than 100 pages of an annual report. Now we must put on the surgical gloves and conduct a financial autopsy. We need to trace the exact path of destruction that a bad, synergy-fueled acquisition carves through a company's financial statements. It's not enough to know that these deals are bad in theory. You must be able to identify the specific evidence of their failure in the numbers. This is how you move from being a storyteller to being a detective, uncovering the clues that management often tries to hide. Our case study for this autopsy is the disastrous acquisition of Snapple by Quaker Oats in 1994. It's a textbook example of a company stepping far outside its circle of competence, wildly overpaying based on flimsy synergy projections, and suffering the brutal financial consequences. Quaker Oats was a stalwart of American pantries. It was a slow and steady, predictable business built on oatmeal, breakfast cereals, and its crown jewel, Gatorade. Quaker's management team was expert at mass production, grocery store distribution, and television advertising. They ran a tight, efficient ship. Snapple, on the other hand, was the quirky, edgy upstart of the beverage world, with its offbeat flavors, glass bottles, and famously eccentric ads featuring a real Snapple employee named Wendy. It had built a cult following. It was a brand built on authenticity and a unique, small-scale distribution network through convenience stores and delis. In 1994, Quaker Oats, hungry for growth beyond its mature brands, saw Snapple and was seduced. The synergy story they told themselves and Wall Street was simple. Quaker would take the hot Snapple brand and plug it into its massive, world-class Gatorade distribution system. They would put Snapple in every grocery store and supermarket in America. They would use their marketing muscle to turn it from a niche player into a global powerhouse. Based on this dream, they paid a staggering $1.7 billion for Snapple. The price was so high that even analysts at the time were skeptical, but Quaker management was convinced the synergies would justify it. The failure was immediate and total. The first sign of trouble was, predictably, a culture clash. The buttoned-down, corporate culture of Quaker Oats was oil to Snapple's water. They didn't understand the quirky brand they had bought. They replaced the beloved Wendy the Snapple Lady with generic, big-budget ads that fell flat. But the bigger problem was the synergy mirage. The core thesis, plugging Snapple into the Gatorade system, was fundamentally flawed. Gatorade was sold in large volumes to supermarkets where it sat on pallets. Snapple was sold by the individual bottle in delis and convenience stores, requiring a completely different, more hands-on distribution model. The supposed synergy didn't exist. Instead of soaring, Snapple's sales plummeted. The very distributors and store owners who had been the backbone of Snapple's success felt abandoned and alienated by the new corporate owners. This is where the psychological trap of the sunk cost fallacy snaps shut. A sunk cost is a cost that has already been incurred and cannot be recovered. The $1.7 billion Quaker paid for Snapple was a sunk cost. Rationally, they should have evaluated the situation based on the future prospects of the business, regardless of what they had paid. But psychologically, that's almost impossible to do. Having spent so much, the management team at Quaker couldn't bring themselves to admit they had made a catastrophic mistake. To do so would have been a career-ending humiliation, so they did what most executives do in this situation. They doubled down. They poured more money into marketing. They tried to force the flawed distribution strategy to work. They kept telling the market that a turnaround was just around the corner. They were throwing good money after bad, trapped by the psychological weight of the initial price they had paid. Finally, after less than 3 years of disastrous ownership, Quaker Oats surrendered. They sold Snapple to a private equity firm for just $300 million. The financial autopsy reveals a loss of $1.4 billion of shareholder money, vaporized in less than 36 months. So where do we find the evidence of this crime on the balance sheet? The applied mental model for the retail investor is to learn how to read the post-merger balance sheet for 3 specific clues. The first and most important clue is the appearance of a massive asset called goodwill. When Quaker bought Snapple for $1.7 billion, it wasn't buying $1.7 billion worth of bottling plants and trucks. The vast majority of that price was a premium paid above the fair market value of Snapple's tangible assets. This premium, which can only be justified by the hope of future synergies, is recorded on the acquirer's balance sheet as goodwill. After the Snapple deal, Quaker's balance sheet would have suddenly shown a new, multi-billion-dollar asset called goodwill. For an investor, a sudden, huge spike in goodwill is the single biggest red flag that a company may have just massively overpaid for an acquisition. It is the ghost of synergy haunting the balance sheet. The second clue, which often appears a year or two later, is a goodwill impairment charge. For a while, that goodwill just sits on the balance sheet, making the company's assets look larger than they are. But accounting rules require companies to periodically test whether that goodwill is still worth what they paid for it. If the acquired business is failing and the promised synergies are clearly not materializing, the company is forced to impair or write down the value of the goodwill. This impairment charge flows directly through the income statement as a massive one-time expense. In the case of Quaker Oats, the sale for a $1.4 billion loss was the ultimate impairment. That loss would have wiped out years of Quaker's accumulated profits in a single stroke. When you see a company you own announce a large goodwill impairment, it is a formal public admission from management that they screwed up. They overpaid, and the synergies were a fantasy. The third clue is to look at the other side of the balance sheet: liabilities and equity. How was the deal paid for? If it was funded with debt, you will see a huge increase in long-term debt on the balance sheet. You should then calculate the company's interest coverage ratio, its operating income divided by its interest expense, to see if the company can comfortably afford its new, higher interest payments. A company that has taken on too much debt to fund a foolish acquisition is a fragile company, vulnerable to the next economic downturn. If the deal was funded with stock, you need to look at the number of shares outstanding. If that number jumped significantly, it means your ownership stake in the business has been diluted. The company may be bigger, but your slice of the pie is now smaller. The path of the 99% is to ignore the balance sheet entirely. They focus on the story and the income statement. After an acquisition, they might see that revenue has gone up and think, "Great, the company is growing." They completely miss the ticking time bomb of goodwill, the crushing mountain of debt, and the dilution of their ownership that was created to produce that superficial growth. The direct financial connection here is profound. That goodwill impairment charge directly reduces a company's book value and, more importantly, its retained earnings. Retained earnings is the portion of a company's profits that are not paid out as dividends but are reinvested back into the business. It is the engine of long-term compounding. A massive write-down is like taking that engine and smashing it with a sledgehammer. It represents years, sometimes decades, of shareholder capital that has been permanently destroyed. Learning to perform this financial autopsy is not an optional skill for a serious investor. It is your primary defense against the value destruction that so often follows in the wake of the word synergy. We have now journeyed through the wreckage of failed mergers, plumbed the depths of executive psychology, and learned the disciplines that separate the masters from the masses. We have dissected the financial statements to find the fingerprints of failure. It is time to synthesize this knowledge into a practical, powerful tool. This is the final pillar. Building your personal shield, a red flag system that you, the retail investor, can deploy the moment a company you own announces a major acquisition. This is about moving from passive observation to active portfolio protection. Your financial freedom depends not just on the winners you pick, but on the catastrophic losers you skillfully avoid. Our final foundational anecdote bridges the gap between failure and redemption. It's the tale of two Microsofts. The first is the Microsoft of the late 2000s and early 2010s, led by CEO Steve Ballmer. At that time, Microsoft was facing an existential threat. The world was shifting from the PC to mobile, and Microsoft had completely missed it. Apple's iPhone and Google's Android were dominating the new smartphone ecosystem. In a desperate attempt to catch up, Ballmer made a fateful decision in 2013. He orchestrated the acquisition of Nokia's handset business for over $7 billion. The strategic rationale was drenched in the language of synergy. Microsoft would combine its Windows Phone software with Nokia's hardware expertise to create a powerful third ecosystem to challenge Apple and Google. They would create a seamless experience between hardware and software, leveraging Microsoft's vast enterprise sales force to push the phones to corporate clients. It was a bold bet-the-company move, and it was a complete and utter disaster. The synergies never appeared. Developers didn't flock to the Windows Phone platform. Consumers, already locked into the Apple and Android app ecosystems, showed little interest. The deal was a strategic failure, born of fear and a profound misunderstanding of the consumer mobile market, a clear case of a company stepping outside its circle of competence. The financial result was predictable. Just 2 years later, under a new CEO, Satya Nadella, Microsoft announced it was writing off $7.6 billion related to the Nokia acquisition, more than the entire purchase price. It was a total wipeout. But this is where the story turns. Satya Nadella's handling of the situation is a masterclass in rational leadership. Instead of falling for the sunk cost fallacy and pouring more money into the failing mobile hardware business, he made the tough but correct decision to cut their losses. He admitted the mistake, took the massive write-down, and pivoted the company's focus away from its weaknesses and towards its incredible strengths. Cloud computing with Azure and its enterprise software dominance with Office 365. He stopped chasing the synergy mirage of the consumer world and refocused Microsoft squarely within its circle of competence. The result? Microsoft stock, which had stagnated for over a decade under Ballmer, began a historic ascent, becoming one of the most valuable companies in the world. The story shows both the devastating cost of a bad acquisition and the immense value that can be unlocked when a new leader has the clarity and courage to reverse a past mistake. The psychological principle at play here is the availability heuristic. This is our tendency to judge the likelihood of an event by how easily we can recall examples of it. When it comes to mergers, the few spectacular successes, like Disney's acquisition of Pixar or Google's purchase of YouTube, are highly publicized and easily remembered. They create vivid, compelling stories of synergy working brilliantly. These available, positive examples create an illusion that such success is common, causing CEOs and investors to overlook the silent graveyard of thousands of failed mergers that don't make for exciting headlines. The statistical reality is that most mergers fail to create value. The availability heuristic blinds us to the base rates. Your red flag system is designed to counteract this bias, to force you to look at the cold probabilities rather than the seductive available stories. Here is the blueprint, your applied mental model, the pre-mortem acquisition checklist. A pre-mortem is an exercise where you imagine that a project has failed, and you work backward to figure out what went wrong. When a company you own announces a deal, you will perform an investor's pre-mortem using this 5-point checklist. First, the word watch. Open the official press release announcing the deal. Use the search function on your computer to count how many times the word synergy or its close cousins, transformational, accretive, game-changing, platform, appear. Now, count how many times the specific purchase price and the valuation metrics, like the price-to-earnings or price-to-sales multiple being paid, are mentioned. If the document is heavy on vague, promotional buzzwords and light on the cold, hard numbers of the price, that is your first major red flag. Great investors talk about price. Bad managers talk about synergy. Second, the price test. Find the target company's stock price the day before the acquisition was announced. Compare it to the price per share the acquirer is paying. This difference is the acquisition premium. A premium of 15 to 20% might be reasonable. A premium of 30%, 40%, or even 50% is a sign of extreme aggression and requires an extraordinary justification. A massive premium means the acquirer is starting in a deep financial hole, betting everything on the hope that the synergies will be massive enough to climb out. High premiums are a strong predictor of future failure and shareholder value destruction. Third, the competence test. Ask yourself the simple question: is the acquired business squarely within the acquirer's demonstrated circle of competence? Has the acquiring company shown a history of success in this specific industry? Or are they making a transformational leap into a new business they don't understand? A beer company buying a cannabis company, or an old-line industrial firm buying a trendy software startup, are classic examples of competence test failures. Stick with companies that deepen their strength in a business they already dominate. Fourth, the balance sheet test. Scrutinize the financing of the deal. Is the company paying all cash from its existing reserves? This is often the most disciplined approach. Are they funding it with a massive new issuance of debt? If so, project how that will impact their credit rating and their ability to withstand a recession. Are they paying with their own stock? If so, calculate the dilution to your ownership. Be especially wary of deals funded with a complex mix of debt and stock, as it often signals a company stretching its financial resources to the breaking point to get a deal done at any cost. Fifth, the management incentive test. This requires a little homework, but it's the most crucial step. Go back to that proxy statement. Remind yourself how the CEO is paid. Does this deal, by simply making the company bigger, trigger a massive bonus for the executive team, regardless of its long-term impact on per-share value? If you find a clear misalignment between the CEO's compensation and long-term shareholder interests, you have found the motive for the crime. This is the ultimate red flag, suggesting the deal is being done for the benefit of the managers, not the owners. The antithesis of this diligent, checklist-driven approach is what 99% of investors do, the hope and pray strategy. They hear the news, feel a jolt of excitement or a pang of anxiety, but they do nothing. They don't have a system. They don't do the work. They passively outsource their financial future to a management team whose interests may not be aligned with their own. They hold on, hoping for the best. This passivity is a choice, and it is the pathway to portfolio mediocrity and, in many cases, catastrophic loss. The direct financial connection of using this shield is the long-term compounding of your wealth. Investing for financial freedom is a marathon, not a sprint. Over an investing lifetime of several decades, the key to superior performance is not just picking a few big winners, but ruthlessly avoiding the big losers. A single stock in your portfolio that drops 80% or 90% after a disastrous acquisition can cripple your overall returns for years, mathematically negating the gains from several of your successful investments. By using this red flag system to identify and sell a company that is about to engage in reckless, empire-building behavior, you are performing essential portfolio surgery. You are removing the cancer before it has a chance to metastasize. This discipline, this healthy skepticism towards corporate deal-making, is what protects your capital gains, enhances your wealth management, and keeps you securely on the path to beating the market over the long run. The word synergy is not just a word, it is a test. And by learning how to see it not as a promise but as a question, you have just armed yourself with one of the most powerful secrets in the world of investing. You have just spent this time fundamentally rewiring the way you look at the corporate world. You are no longer just a passive consumer of financial news. You have acquired a powerful mental tool, an insider's lens, that allows you to detect the subtle signals of value destruction before the rest of the market even knows what's happening. This ability to critically analyze the decisions of a CEO, to separate the compelling stories from the hard economic realities, is not just a skill, it is a permanent upgrade to your financial operating system. You now possess the owner's mindset, the shield that will protect your capital from one of the most common and devastating traps in the stock market. But what you've mastered today is a single, crucial node in a much larger network of mental models that the world's greatest investors use to navigate the complexities of the market. Warren Buffett's system is not just one idea, it is an interconnected latticework of principles. The discipline to avoid the synergy trap is powerfully connected to the way he evaluates competitive advantages, the way he thinks about debt, and the way he assesses the character of management. You have just forged a vital link in that chain, but the other links are still waiting to be connected. Understanding one piece gives you an advantage. Understanding how they all fit together gives you an almost insurmountable edge. The video that is now appearing on your screen is not an accident. The algorithm has identified it as the next logical step in your journey. Think of the knowledge you've just gained as a key. That video is the door to the next room. It contains the missing link, the concept that will snap into place with what you've learned today, amplifying its power and revealing a deeper layer of the overall strategy. The choice to click is not about watching another piece of content. It is a decision about who you want to become. Are you someone who collects random pieces of information, or are you someone who is committed to building a complete, coherent, and powerful mental arsenal? The path to becoming a truly sophisticated investor, to achieving lasting financial freedom, is a continuous ascent. You have taken a massive step forward today. The next step is right there, on the screen. Continue the climb, complete the map. The choice, as always, is yours.